Continuing with managing credit and credit in America, we're going to cover types of credit. I'm actually only going to cover this first learning objective, not the second, for sake of time. So let's talk about what the different types of credit are. So there are open-end credits, which is basically credit cards and revolving agreements. Then there's closed-end credit, which is a loan that we would have to repay down the road. And then there's service credit, which we're not really going to cover. So let's talk and focus most of our efforts here on open-end credit. So open-end credit allows you to borrow money up to a stated limit, and then you typically will pay that back in 10 to 25 days, the entire balance. And if you pay by the due date and pay it in full, then you do not have to pay any interest on it. But if you pay it by the due date and just pay the partial balance, then you're going to have to pay interest on whatever you didn't pay off. And if you pay after the due date, then you're typically going to have late fees and penalties that you have to pay. And you can keep utilizing that credit over and over and over again as long as you don't go above that stated limit. And again, charge cards are typically a 25-day billing period. So as far as credit card agreements go, there are different components that you need to know about. And we have a slide that will go into more detail about each of these. And we're going to focus our time more on these first 4 or 5 and not go into the method for calculating the finance chart. You are also going to have an activity where you will get to look at a credit card statement and identify those components and answer some questions. So that's part of what your assignment will be. As far as what credit card agreements are, again, it's a form of borrowing that involves interest and other charges, and there are terms to these credit card agreements that affect the overall cost of the credit, so you have to pay really close attention to these components that we were saying we would talk about. So the first one that I would consider is the annual percentage rate, and that is the cost of the credit expressed as a yearly percentage. So we remember this hopefully from Chapter 6 that we had annual interest rates. So a lot of borrowing will be 4, 5, 6, 7%, but on credit cards it's typically 18 to 22%, so it can be a lot higher cost of credit to give you that convenience. So pay attention, cards vary, you can get 12%, 15%, that's a big deal because it's part of the cost. Another thing that matters a lot is your grace period. So this is the time frame within which you can pay your current balance in full and incur no interest charges. So if it's due, let's say on April 22nd, your credit card bill, and you mail it or send it and it gets there on April 25th, if you have a 5-day or a 3-day grace period, then you're still fine and they're not going to charge you any interest. So a grace period kind of gives you another day or 2 or 3 of free credit with no interest costs associated with it. Then there are fees on credit cards. So a lot of cards will charge an annual fee of $20, $40, $50. Other cards will not. So when you're looking at a credit card that you want to get, check to see what their annual fee is going to be and try to get them to waive the annual fee. Then a lot of them will have transaction fees for every type of transaction you have that you have to pay a certain amount, or you can get those waived. And then a lot will have penalty fees that if you are past due or take out advances against it or anything like that, that you'll have to pay a fee. And then there's different methods of calculating the finance chart. You just want to be aware of these methods because they can really impact greatly the amount of finance again, that was open-end credit with credit cards or revolving credit. So then the other type of credit is closed-end credit, and it is a loan for a specific amount, and it has to be repaid in full, including all the finance charges by a specified due date. So it's paying that principal and interest at a specified due date. It's also known as installment credit. It doesn't allow me to keep borrowing, paying off, borrow, pay off like a credit card does. But instead, it allows you to borrow once and then make payments either continuously till it's paid off or to make one lump sum payment at the end. And this is what we typically use close-end credit to buy cars and houses and furniture and major appliances and things like that. It's closed-ended credit. So open-ended credit, closed-end credit are the two big types. There's also something called service credit, which you can look at if you really want to, and then the chapter goes into different sources of credit of where you can obtain credit from retail stores, banks, credit card companies, pawnbrokers, finance companies, private lenders, which is the most common by far, and other sources as well. So if you have an interest in obtaining credit in the near term, it may be worth seeing what your options are of sources and where you could go get it.